Hello, welcome back to Learn Economia. Today we are going to discuss the concepts called adverse selection and moral hazard. So let's have a look on to these. Before beginning our discussion related to adverse selection and moral hazard, it's very important to see the roadmap of today's discussion. So we'll provide you an introduction to both adverse selection and moral hazard initially, and then we will be considering the meaning of both adverse selection and moral hazard individually. We will be looking onto the causes of both adverse selection and moral hazard. Also, the example to both adverse selection and moral hazard would be discussed. Later, we will be considering the consequences of both adverse selection and moral hazard. After that, we will be checking the ways to avoid these instances. Later on, we will be looking onto a comparison of both adverse selection and moral hazard, and finally, we will be concluding the session. Now, when we consider adverse selection and moral hazard, these two concepts are playing some important roles in the arena of economics. Why? This is so because we are living in a context where there is imperfection. So imperfection is actually ruling the way in which we are living, the context in which we are living. Just see the market that we are having around. So we are having all the imperfect type of competitions. We are having all the kind of uncertainties, risk, etc. in our life. And in this context, we could find that there can be element of risk, and this risk will be leading to losses as well. And in this scenario of imperfection, in this scenario of uncertainty, in this scenario of risk, what happens is that we need to ensure that we are having adequate information, because the more information you have, the more will be the chances of profit, or less will be the chances of loss. So this is something that we have to consider. So whenever we consider the problems of adverse selection and moral hazard, we need to understand that these two are some problems that come in the arena of imperfect market structures, and this can be just due to something called asymmetric information. So what does it mean by asymmetric information then? Asymmetric information means the two parties who are involved in a transaction would be having different levels of information. For example, just think about a transaction. In this particular transaction, there could be two parties involved, a buyer and a seller, right? So in this scenario, the buyer will be having certain information regarding the quality of the commodity that he would be trying to purchase, and the seller would be having some other level of information regarding the quality of the product that this person would be selling. So the perceptions that both these people are having, the kind of actual information that these two people are possessing, will be influencing something called profit loss situation. So the person with more information will be gaining, whereas the person with less information will be losing. So coming to this asymmetric information and its implications in the form of adverse selection and moral hazard, these are something which is very, very common in the insurance market as well as financial market. So let's have a detailed look onto something called adverse selection and moral hazard separately. Moving on to the context and meaning of adverse selection. When it comes to adverse selection, as I was already telling you, this is something that will be happening when there is a context called asymmetric information. So when we talk about asymmetric information, it's all about a kind of imbalance of information. The two parties involved in a transaction would be having different levels of information. And what would be the result? The result is that it will be leading to inefficiencies in the market. So the market will be failing, which we call as there is market failure. And can this happen? When we say that there is market failure, we mean that the price at which a good or service is sold in the market will not be reflecting the true quality of that product or service. So this will be a clear instance of market failure. We have to understand more about this context. Let's have a look onto this. Now, coming to something called adverse selection, we are looking on to something called a wrong selection. So, adverse selection itself is talking about a wrong selection. How can you consider a wrong selection? The wrong selection means you were unaware of the actual quality of the product or service, and for the same reason, accidentally you are falling onto a trap by going for a bad selection. So for the same reason, adverse selection is also called as a hidden information problem. Hidden information problem. So you are not having enough information, and for the same reason you will be going for a wrong selection. This is called adverse selection. This adverse selection that you would be making today will be having several implications for your future. We will see more about it. Let's first of all understand the causes of adverse selection. The very first cause, yes, it's information asymmetry or imbalance of knowledge, imbalance of information. And also, if you look at insurance market, what you can find here is that the people who would be having a high chance of having some issues in future, they would be the ones who will be going for insurance policies. So the market IMF tells that the high risk individuals would be purchasing something called insurance, isn't it? But sometimes what will be happening is that it's not sometimes, in most of the instances this would be happening. The concerned person might not be telling the true character of this person to the company which would be giving insurance to this person, and for the same reason the company might not be having enough details regarding this person, and for the same reason the company might be going for adverse selection if that company chooses to give insurance to this concerned person. Always high risk people are going to take insurance. This is what is usually happening in the insurance market. So let's see an example of adverse selection here. You can just think about an insurance market. Let it be a health insurance market. Okay. So just think that there is a person who is a smoker. This person is a smoker, and he is very active in smoking, and he likes to smoke as much as cigarettes as possible. This is his love for smoking. So one day, one of his friends has told the smoker to go and take an insurance, and the friend is telling the smoker that do not reveal that you are a smoker. So when the company asks you whether you are a smoker or not, do not tell the company that you are actually a smoker. So this smoker is now approaching the company, the insurance company, to take insurance. Now, one of the questions that this insurance company would be asking to this person would be, are you a smoker? So if the company is asking this question to the smoker, are you a smoker? This is a question that the company is asking to this person. The smoker knows it very well that if he tells yes, the company will be charging him a very high premium. So for the same reason, the smoker will say that, the smoker will tell the company that no. Unfortunately, this company is not having any other way to find whether this person is actually a smoker or not. So what happens is that the company might be trusting the smoker, and the company will be giving insurance to the smoker by going for a low premium. So this is so because the company doesn't know the actual behavior of this person, isn't it? So that is one way. In this scenario, what happens is that when the company gives insurance, to this person, Companies give insurance means the company is actually going for a wrong selection, or the company is going for adverse selection or a very bad selection due to incomplete information. So this would be a problematic scenario. The company is not able to assess the actual risk involved here. Sometimes it can happen the other way also. Sometimes the person who is going to take insurance, the insurer might not be able to understand his actual risk. So for the same reason, he might be having a tendency to believe all those just unnecessary part of the explanation given by the company. So the company would be trying to ensure that the person is going for insurance. So in that case also, there can be problems of information asymmetry. So always what happens is that the entity with more information, this person would be the gainer, or this entity would be the gainer. And entity with less information, this party would be having a loss. This party would be the loser. Now, if that is the case, what all could be the consequences or impact of adverse selection? So if you look at the insurance market, what happens is that if the company is not able to assess the quality of people who are coming to take insurance, if the company is not able to assess the actual behavior of the persons who are coming to take insurance, what happens is that the company will be charging a higher premium. So this higher premium will be applicable to everyone, irrespective of whether the person is a smoker or not, because unfortunately the company is not able to distinguish between a smoker and a non-smoker here due to less information available. So this might be causing exclusion scenario, because as a result of this high premium, or as a result of this high prices for insurance, many people would be going for some option to avoid insurance. So many people would be thinking that it's not a better idea to go for insurance. So they will be staying away from taking in insurance. Also, we could find is that what we could find here is that there can be chances of quality reduction. This is so because the sellers of high quality products, insurance products, would be exiting the market. If they are charging lower prices in the market, they think that it's not a good thing to stay in the market. So they think that it will be causing some issues. So the sellers of high quality goods, they will be exiting the market because they would be having a loss. They will think that they are actually giving high quality insurance to people, but unfortunately they are not getting enough prices. They are getting loss due to the people telling lies about their true behavior. So they will be thinking to exit the market. So the quality of the insurance market itself will be affected very badly. So here the company is having a loss. So that is why they are exiting. the market. So this will be affecting the insurance market itself. Now, how can you avoid this adverse selection? There can be several ways to deal with this problem. First thing that you can do is that the company can go for some methods of risk assessment. The company should know the status of its risk. The company should first of all understand what is its true income, what all are its sources of income, what all are its sources of expenditure. Then the company with its previous information gained or with its past data can go for some future prediction. So it can use past data and go for some kind of forecasting. So with this, it can go for some assessment of risk and go for something called a kind of premium that will be making it to have less loss. And also the company can go for something called differentiated pricing. So the company need to ensure that it is going for some proper way of assessment of the behavior. So behavior assessment is very, very important way of assessing behavior of people. So how can that be done? One of the ways that the company can go for is that it can ensure that it is asking some different questions in such a way that the one question will be cross-checking the answer given for the other question. So that is very, very important. So once these kinds of questions are made in the questionnaire given by the company to the person who is there to take the insurance, to some extent with proper analysis of this questionnaire, by going for the proper analysis of the answers given by the concerned person, the company will be able to get some kind of understanding regarding the true character of this person. So based on this true character, the company can charge a differentiated pricing. So for those people that the company think as risky, for them, the company can charge a high premium. And for those people, the company consider as less risky. For them, the company can charge a less premium. So in that way, the company can go for differentiated pricing so as to reduce its risk. Now, after understanding the context, meaning, examples, as well as causes and consequences of adverse selection, now let's have a look on to moral hazard. What does it mean by moral hazard? Moral hazard is a scenario where one entity would be taking more risk because that entity is thinking that the consequence or impact of that risk would be borne by somebody else. So this would be happening after a transaction. But when it comes to adverse selection always happen before a transaction. But here you could find that this is before, adverse selection is before, and coming to moral hazard, it is happening after a transaction. Moral hazard is happening after a transaction. So what is happening actually? This moral hazard is called hidden action problem. Hidden action problem. So why is it called as hidden action problem? It's called as hidden action problem because after purchasing insurance, the smoker can go for consuming more cigarettes. So unfortunately, the insurance company is not able to monitor the smoker. So for the same reason, this will be creating issues for the company. This will be creating more instance of loss for the company, or the chance of having loss to the company will be much more. Now, what would be the cause of moral hazard? Definitely one of the important cause that can happen in insurance market is the coverage of insurance. Because unfortunately, the company is not able to monitor everyone. Impossibility of monitoring. Impossibility of monitoring. This is one of the issues. Now, lack of accountability. How lack of accountability? Unfortunately, the person who is taking insurance is not asked to behave accordingly as per the rules and regulations of the company. The company might be telling this person to behave in that way, but the company is not having any provision to ensure this accountability. So this accountability aspect is not at all ensured. The kind of contract that exists between the company and the person who takes the insurance That is not maintained in most of the instances by the person who has taken the insurance. So unfortunately, the company is not able to monitor all these kind of things, leading to something called moral hazard. Now let me give you an example. Just think about a bike rider. So who this person is very much interested in riding the bike. Unfortunately, this person is a fast rider, and for the same reason, as a result of the recommendation given by his friend, he has gone to insurance company to take an insurance. So just think that he has taken an insurance. He has taken insurance, but in this insurance market, this person was not telling that uh, he is a fast rider. So that was not told to the company by this person. So now he has got insurance. So as a result of this insurance, what he thinks is that if I ride fast, I will not have any burden, because if at all there is some kind of issues, the company will be bearing the burden. So I will not be having any financial burden, and for the same reason, after taking insurance, he can go for something called a reckless drive, or he can go for something called a kind of irresponsible ride. So for the same reason, this will be creating instances of accident, and for the same reason, this will be increasing the risk of loss of whom? Of the company. Because unfortunately, the company is not able to monitor this person, and for the same reason, the company might not be able to understand whether this person is behaving as per the rules and regulations or not. So this will be creating something called moral hazard, the hidden action problem. Now, what would be the consequence? Definitely, there would be more claims. So if there are more people who are not obeying the rules and regulations of the company, definitely after taking insurance, people will be having a tendency to behave as per their likes and dislikes, and for the same reason there can be increased chances of raising claims. So this will be leading to loss of the company, loss of the insurance company. So unfortunately, this will create a market inefficiencies also, because one party always having loss means one side of the market would be always down, isn't it? Over a period of time, this will create some instability for the economy itself, because earlier the insurance sector was having some kind of projections regarding to what extent claims would be coming, but now the company is actually experiencing more number of claims, means it is exceeding its projection. I mean, the claims, actual claims are exceeding the projections made by the company. This too would be making the company to have a loss, and for the same reason the company would be exiting the market. So the insurance sector would be affected very badly. So the almost the same kind of things would be happening in the financial market. The person with more information would be gaining, and the person with less information would be losing. Now, what will happen when there is more hazard, something very bad? This is something that we know. Now, let's see what are the ways that we can use to avoid more hazard. The first thing that you can go for is called deductibles and co-payments. So when there is some issues happening to the person who has taken the insurance, the company need to ensure that if that incident has happened just because of the carelessness of the person, then the company can demand a co-payment. So that means 50% of the payment can be given by the company, and the rest 50% should be from the side of the person. The 50% of the cost can be met by the company, whereas the remaining 50% should be met by the person concerned. So such kind of agreement can be made. Also, the company can ensure that it's going for some monitoring. So this will be something that is possible by going for some timely, regular supervision. Some regular supervision would be ensuring that to some extent people are monitored or people's actions are monitored. And if the company finds that people are behaving in a good manner, as per the rules and regulations of the company, such people can be given some incentives by the company. And if at all somebody is found to be behaving in the opposite manner, the company can cut the incentives and the company can impose some penalty on these people. And also, what a company can go for is that the company can ensure that there are some clear contract terms. And this clear contract term should be something that should include what to do after taking insurance, what to do and what not to do after taking insurance. So these kind of things should also be made clear after insurance. So these are some of the ways that we can go for to avoid moral hazard. Now let's have a comparison between adverse selection and moral hazard. Both of these would be happening as a result of information asymmetry. And for the same reason, we can find that both will be happening due to some kind of issues in the market. Both will be creating some instances of failure of the market. And we could find that both of these are happening in different periods of transaction. Adverse selection is actually before the transaction and moral hazard is happening after the transaction, isn't it? So adverse selection is just because different people are having different amount of information about the risk levels and about some other aspects, etc. And moral hazard is just after the contract. That means one person or one entity would be having a tendency to exploit the lesser information of the other person or other entity, because this person who is having more information would be having a tendency to think like this. He thinks that the other party or the other entity would be taking care of some cost of this person. So this person, the first person who will be having more information, is having a tendency to go for all those actions that are against the contract between these two parties, because the person who is actually dealing with those unacceptable behavior is very pretty sure that if something bad is happening, the other party will be having the cost. That is why he is doing all these kind of bad things. So in short, it's very important to understand the meaning, context and causes as well as consequence of both adverse selection and moral hazard. Why? This is so important to come with some effective policy measures. Especially when it comes to the arena of financial market and insurance market, we have to go for these effective policy measures, because both these insurance market and financial markets are playing a very important role in our economy. We cannot do away with these. So we need to ensure that these markets are coming up. So for the same reason, we need to ensure that the instances of these problematic scenarios of adverse selection and moral hazard are coming down. So what we can do is that insurance company can enhance their efficiency by going for several methods, like going for monitoring, going for co-payments, etc., so that they will be able to protect them from some potential losses. So this is very important. So that's all for today. You can download the Learn Oikonomia app, where you will be getting the previous year question papers and answers, free study materials, live and recorded classes, free MCQ based weekly test, and much more. The only thing that you can do here is you can click on to the link that I'll be providing in the description box. Just check the description box for the same. And you can also join our Telegram community to have discussions. For that also, I'll be providing the link in the description box. That's it. Thank you for watching.